My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be able to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach, and yes, at times, criticize. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You know what? It's the revenge of the old guard. Right now, right here. All sorts of boring conventional companies are taking back the market, while the digitizers and disruptors are being burned at the stake. That includes today, where the Dow gained 334 points. That's where the action is. The industrials, the S&P climbed 0.56%. NASDAQ advanced 0.49%. I don't think that'll happen tomorrow, though. Yeah, we got to acknowledge something here. We got to acknowledge that regardless of what happens in the midterm elections tonight, this market's going through something that's roughly analogous to the dot-com collapse. Tech is now for sale in large part because of incredible competition everywhere. For the longest time, tech companies grew and grew and grew because they had the field to themselves. Amazon owned e-commerce, then cloud infrastructure. Microsoft owned Windows and Outlook, enterprise software. Facebook owned social media, buying any major competitor like Instagram. Apple had the best consumer technology. Netflix owned streaming. Google owned search. Salesforce owned customer relations management. Workday, ServiceNow digitized what the other guys didn't. They each had their own separate domain where they were untouchable. But then they all started going against each other. Microsoft's Azure goes up against Amazon Web Services, which goes up against Google Cloud. Netflix now competes with half a dozen streaming services, including Disney+, which reported such a horrible quarter tonight that I am stunned. And I'm addressing the situation with Investing Club members this evening in a very harsh way. Highly unusual for me. Meanwhile, everyone got into gaming. Every enterprise software play wanted a piece of customer relations management. They're all taking it. And these are just the kings. There are lots of smaller vassals that digitize finance or real estate or the auto industry, including Tesla, which has become a broken stock, even as the underlying company's in good shape. Carvana, broken stock, broken company. Or how about the free-for-all that's tech lending? I mean, holy cow, fintech lending is just, it's disastrous. A firm reported a good quarter tonight, but a weaker forecast. CEO Max Levchin will be on the show later on to explain. Upstart gave you a miserable forecast, and it is being crushed. Sell. Can't say I didn't predict that one. Although I sure did get Disney wrong. Get some right, you get some wrong. Meta's the worst performing stock in the S&P 500. No wonder. It needs advertising, and ad dollars are in short supply going into a huge slowdown. Major layoffs expected there, according to the Wall Street Journal. As I said to David Faber this morning, I think they start tomorrow. Perhaps worst of all is crypto. Crypto's in meltdown mode. Some of these are in such dire situations that I actually don't want to comment on the players on air. Let me put it this way. This morning on Twitter, I said that a bet on Bitcoin is a bet on the balance sheet of Sam Bankman-Fried, a colorful character who seems to be the J.P. Morgan of crypto. Poser? Savior? Who the heck knows? We do know this. The global market cap of all crypto fell below $1 trillion today. It was nearly $3 trillion at the high almost exactly a year ago. You know what? That should make J-Powell smile. The Fed wants to crush all things speculative. There's nothing more speculative than cryptocurrency, even as the people who push it would tell you that it is better than gold. Yeah, that's what's getting obliterated here. But now let's talk about who's winning, because I'm sick and tired of being so negative. No, I'm not. That Disney revolted me. Upstart. All right, I'm done with being negative. Who's winning? How about companies that don't have much competition? Or at least the competition is so muted that it can't disrupt the status quo? Yeah, let's start. You probably heard some of these. I like the crypto fintech stuff. You probably heard of some of these, okay? It's not like the Ethereum. I'm talking about, let's start with pharma, okay? How about that? Let's deal with that. If you look at what's really working in this market, well, here's two shockers. Johnson & Johnson and Lilly. You ever hear of those? Were they in Silicon Valley? No. these guys depend on products with a very long shelf life. J&J's compounds are incredible, whether they're talking cardio, drugs, cancer treatments, medical devices, even the consumer products business that they're spinning out. I like that. They have trust. Eli Lilly may have the Holy Grail, a diabetes drug that also promotes weight loss. And they're totally hush-hush about what could be a game-changing Alzheimer's drug, unlike Silicon Valley, which would tell you that they've already cured everybody. You just don't know it. Then there's aerospace, particularly Boeing. Now, this has been one of the worst managed companies I've ever seen. But that era seems to be coming to an end, right when we're also seeing a stunning shortage of planes. And it's not like their only real competitor, Airbus, can fill all the demand. For the longest time, we figured Boeing would have to beg the Chinese airlines to keep their orders. Now, I think the shoe's on the other foot because there's an aircraft shortage thanks to the booming travel business that has airlines eager for more capacity. You know what, China? People's Republic, listen up. You're too late. Boeing stocks caught fire over the past 6 weeks as people realize they don't need any China orders at all. And it's taking up all things aerospace with them. How about Honeywell? There's a good company. Do you really buy now, pay now? Hey, I like that. Raytheon, buy now, pay in advance. I don't know. Again, unlike the tech disruptors, these aerospace plays tend to be part of benign oligopolies. They're not really competing. Well, it's gentle competition. It's Harvard, Yale, you know what I mean? There are literally only two companies in the world that make large commercial aircraft at scale. They aren't about to be disrupted by some outfit in Silicon Valley that's not even in a garage. It's in a big island in Hawaii. I think Caterpillar's in a similar situation. There are only a couple companies left that really know how to make earth movers at a time when we're about to move billions of tons of earth as part of the big federal infrastructure bill. Cat's going to end up with more orders than it can handle. Mark my words. And I can say the same thing about Deere. Listen, I know you're not supposed to buy something like Caterpillar going into recession, but what if this recession ends up being short-lived because there's so much infrastructure sloshing around? Of course, the laid-off computer scientists and software engineers, they might not fit into the assembly line. I mean, that Stanford degree, you know, the computer science degree, it doesn't really help you on the assembly line. But you know what? Good. Those guys had they had their time. They made their money. They made their fortunes. Meanwhile, we're seeing a remarkable performance from PepsiCo. Yeah, and why not? Their costs come down to food, plastics, cans, some glass. All these commodities are coming down big. Next year, Pep will have radically lower costs. In the old days, Wall Street preferred microchips, but now the semiconductor space has become viciously competitive. These days, if it comes down to a choice of Doritos or Intel, I say, make mine Cool Ranch. How about Starbucks? Man, you seen that horse? It's incredible. It's been on fire. Why? Because it's actually harnessing technology, thank you, Howard Schultz, to make cold coffee in its various levels. Turned out the cold brew is what anybody wanted, but Starbucks couldn't make it fast enough. Now they got the machines to do it. They are taking back an entire industry that they almost lost, that they invented. Maybe the best example of a company that can't be disrupted, one that's in ascendance, even as its stock can't get much love at all because of recession fears, is a company called Nucor. This is the largest, most efficient steel maker in America, perhaps the world, because the other guys are all, who knows what their numbers are. In many ways, Nucor is the poster boy for what I'm talking about. A company with a stock that sells for less than 5 times earnings that I think is going to have a huge fourth quarter and an even bigger next year. And I don't care about Jay Powell. How is this possible? How about because Nucor makes the most sustainable steel in the world? Steel that can help automakers like GM meet their own environmental goals. How about because all that federal infrastructure money will go to the states, which will then turn around and buy the steel from Nucor because they're the only game in town? Yeah, it's kind of like the way Microsoft was in 1998. Remember that? How about all the orders it's going to get from the CHIPS Act? Oh, we could go on and on. You know, there could be $100 billion invested in building semiconductor foundries. How about the fact that Nucor makes the cheapest and strongest windmill steel in the world? Eventually, I expect it's going to be one of our largest leading exports. While nearly all of its competitors were downsized and merging or going under, Nucor kept investing in its plants and, more importantly, its people. They're practically the last man standing. So let me give you the bottom line of this rant. This market's still full of people who haven't adapted to the new reality. They're looking to find the right level to start buying Snap. They want the carcasses of software as a service. But me, give me Nucor steel. Holds up longer, more uses. They're facing little competition as the once great tech stocks used to have. And I got to tell you, now I'm restricted, but I'm thinking this is a better stock to own for the club, than the investing club, than any. Well, no, I like a lot of this. I love the Lilly and J&J, some of the board. But you know what I mean? I'm sick of tech. Bernie in Pennsylvania, please. Bernie.
Hey, Jim, a Big Ten, Penn State, booyah to you.
Well, Jeff Marks, booyah, right back at you. Penn State is a Nittany Lion.
Yes, sir.
Yeah. Hey, so's Miles Sanders, if you want to go there. I like Sanders. Go ahead, I'm sorry.
I do, too. I want you to look at Workday.
Look, I think Workday's doing a terrific job, and Neil Bushry's doing great, but I have to tell you, I'm not that fond right now of these software companies that have high multiples. I am looking for hardware companies that aren't in tech that have low multiples. All right, listen, the market's still full of people who haven't adapted to the new reality. We've been trying to get out of tech for months now for the charitable trust. And I got to tell you, tonight, good example, Zoom. That actually may be the right level. I don't know. It's falling along with the broader tech cohort. Maybe the stock's poised to finally go higher after the fact that it's got a great balance sheet in Zoomtopia 2022. Let's get the information from the latest from the CFO. Then the IPO class in 2021, rough year, right? And after falling from its highs, could Portillo's be poised to buck the trend after reporting a host of good numbers? I'm talking to the CEO in front of the company's famous beef bus. I prefer a beef bus to Disney. Mickey should be ashamed. And a firm has felt the pain of the fintech meltdown, and I'm learning more about what the company has in its pipeline with the CEO. Another tough one. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.